Hello and welcome to FinTech Insider On Air, episode 14. So just before we get into it, apologies for some technical problems in episode 13 and also on episode 3 of Home Screen. We've been battling some Wi-Fi issues in the building. But if you haven't already checked out the previous episodes, please do so. They're all available on David's Periscope. We've also started uploading them to YouTube, so you can check out the previous episodes there. So I'm Sarah Kocianski, and today I'm joined by Jason Bates. How are you today, Jason?
I'm good, thank you. How are you?
I'm good. We're going to be talking about insurance. Exciting, right? So the story that's you sound so enthusiastic. So for those who don't know, Insurtech is kind of my baby. I run the Insurtech Insiders podcast, and
I'm looking to learn so much.
Yeah, exactly.
That's what the only reason I'm here. Teach me. So.
David's off sick, so I was like, I'm taking control.
Nice.
So the topic today is Insurtech funding a bubble? And this is based off the back of a story that Lemonade, the insurance startup, was valued at $2 billion recently, following a $300 million Series D funding round led by SoftBank. So do you know anything about Lemonade, Jason?
I do a little. I know they're the startup that everyone brings out when you talk about Insurtech, because they definitely seem to be leading the way in that, in asking the right questions, talking in a non-insurancy kind of way, having a sort of a new approach. Tell me more about it.
Absolutely. No, you're absolutely right. So the way they've gone about doing insurance is very much sort of from the bottom up. They've rebuilt everything. And one of the reasons people talk about them a lot is because they're actually what we call a full stack insurtech.
Right.
So they underwrite their own insurance. A lot of insurtechs are just sort of really nice front ends for going through that purchasing process.
Yep.
But then on the back end, you've got an insurer actually doing the traditional processes and businesses.
So how many kind of layers of this stack are there for people who don't know about it?
Well, so when you go to buy insurance, Lemonade specifically does contents, well, renters as we'd call it. So contents in the UK, renters in the States, and homeowners insurance. And typically in the UK, that purchasing process is you go online and you would go to a comparison supermarket and sort of enter some stuff roughly, and it would give you 40 different options, and you would just normally, if you're most people, pick the cheapest one.
Okay.
But the problem with that is a lot of the time that you end up with coverage. First of all, you have to decide that you want to do it. And a lot of people do not have contents insurance. It's sort of, if I had money to spend today or money that might cover me in the future on the off chance my house burns down.
Right.
A lot of people right now say, I'd like money today. So that's the first step, is getting people to do it. And then the second step is that if you do go through that process, you often end up with insurance that is not really fit for purpose.
Okay.
So anything happens. So you think you're covered for your laptop being stolen, but it turns out your laptop is only covered if it's in the bottom drawer in your bedroom every time you leave the house.
Sure.
So what Lemonade has done is kind of strip back the proposition. So it starts at $5 a month for a renter and $25 a month for a homeowner. And the way you purchase their insurance is through a chatbot. And they ask you, rather than asking you questions sort of like, what was your grandmother's maiden name and how many meters away from the sea do you live? They ask you questions that are much easier to understand. Do you have a laptop? Do you have a bike? That kind of stuff.
But the full stack thing, though, is that they're not selling someone else's insurance policy, which is then, I guess, through some brokers, which then goes eventually to someone with a massive stack of money that takes lots of money, and a small proportion of those people actually have to get paid for that, and therefore they give it out. Because my small understanding, and would you believe I did a year working at Aon, like way back in the day, with insurers and reinsurers and all of that kind of thing. But my understanding is that you have to have like that massive pile of cash, because without that scale, if you've only insuring 10 people and 3 of them have that laptop stolen from the bottom drawer, and now we know that it's stored in the bottom drawer, we're over there, then you get out of business very quickly. But at scale, the maths works. So is that the case?
Yeah. So apologies, I misunderstood. So the way that Lemonade have done it is, you're absolutely right. Like, and this is going to be important for a conversation later. Insurance is expensive. Like, running an insurance business is incredibly expensive. What Lemonade have done is strip out a lot of those layers in the middle. So rather than being the broker who goes to the insurer, who then goes through all these steps to calculate your risk, Lemonade has got an awful lot of automation all the way through its business. So the obvious automation to a consumer would be when you're onboarding, when you go to make a claim, you can make a claim and be paid out in literally minutes because it's all done automatically. But then also all their internal processes use a lot of automation, their workflow management, their testing, their deployment. So because they can strip sort of costs out there, it means that they are more able to price. Well, they are able to price us at a lower price point. And the other thing they do, which is really interesting, their business model is that they charge a percentage as a flat fee. So rather than a lot of the time the amount you pay is based on either a set policy because you fall into this bracket, or kind of it can vary based on what is effectively a black box as far as the consumer's concerned. Lemonade just say it's this percent, and that's what we're taking. And then if at the end of the day, or at the end of the year rather, there's money left over, so people have paid in their premiums, not that many people have claimed this year, we've taken our fee, so traditional insurer would be like, and we'll have all the rest of that, thank you very much. Lemonade gives that money to charities.
Wow.
And when you sign up, you choose which charity. So you whatever's close to your heart, you pick one.
So rather than the lipstick on a pig, where you've got the traditional insurer and the guy who's swigging his beer and underwriting and having his insurance sort of claim reinsured against his mate who works down the street and everything else, and then types that into a system which then gets translated to some lovely new animated interface. They've changed that. They've gone sort of deeper.
They're one of the few people who I would say has actually gone beyond, as you said, you said lipstick on a thing, but beyond that kind of like distribution channel and really rethinking about the mechanics of insurance, which I think is why this valuation is not unreasonable. You do have to accept that insurance, like banking, is an expensive business if you're going to start one from scratch. And the 300 million they've raised is a Series D, a 2 billion valuation. We've seen other insurance companies in the States who perhaps aren't quite, don't have quite such a full proposition raising more. So Oscar Health raised 400 million last year. And the other thing is, if you look at Lemonade, because they're so tech heavy and they're also very transparent, they've published their loss ratio, which is basically, if your loss ratio is 100%, you're not making any money as an insurer. And Lemonade's was sort of 150, 160, whatever. Oh, wow. And then last year they got it down to 99.
Okay.
But the point is that they're moving that way.
Sure.
And for a young company, there are plenty of companies getting lots of money that can't prove that yet.
Sure. And to a certain extent, I assume that's the valuation why SoftBank's interested, because anywhere in financial services where you have a lot of intermediaries, you have a lot of layers, you have a lot of paper-based processes that are being digitized, you have very big bloated back offices, then there's the opportunity there to do something interesting with enough capital. And I guess you start with digitizing at a very low cost the thing that's out there already, before moving on to more innovative plays, and then when you're there and you're not working out the T's and C's to one rock solid policy that applies to everyone, but you can start to really do the data science and the maths and the sort of make things very much more tailored. It gets more interesting, and I guess SoftBank are looking at this to say, like, Lemonade could be one of the next big, global insurers. Yeah,
no, absolutely. I mean, and they've already said that. I mean, to go back to your point about paper-based, Lemonade says that each of their employee handles 2,500 policies.
Right.
Because so much of that cost is stripped out by the automation. And these are stats from Lemonade. So if there are problems with them, please go to Lemonade rather than me. But they say that State Farm, which is another really big insurer in the US that does contents and home insurance, each staff member handles 500 policies.
Right.
So already those cost efficiencies, those efficiencies at scale are being proven. And Lemonade have said that they're going to use this money, this 300 million, for their plans expansion to Europe. So they announced last year that they were coming our way. And they also said that they're going to be hiring staff, but I imagine that's more about staff on the ground to get the business up and running rather than kind of expanding their teams to scale. I guess they've kind of already proved they don't need 1 million more people to do what they're doing.
Yeah, well, I mean, it's the big change, isn't it? It's the analog to digitized. All the insurance companies come along. They all add an interface. They all add a nice sort of edge on. They connect to some aggregator. all's well and good, but still the big black back office bloated human-based paper-based systems that they've added to and modified over the decades, have to be there in order to run such a large successful business. But the next step is a rethinking of that and going back to the kind of the base components of it, which we're seeing in banking and retail and transport and hotels and everything. I think that looking at what digital can provide now and really looking at customer problems, what do they need, rather than the one policy that we banded around the street or went to Lloyd's of London for, suddenly it becomes something else. I think it's that the difficulty of the step from digitized to digital that then means that a business like Lemonade comes along and said, well, actually, we're starting in the digital bit, like analog to digitized to. You never get over that hurdle. No.
Yeah, I mean, I think that's the thing with Lemonade as well, is that the founders will say as well that they started at the bottom. They were like, we're rethinking insurance full stop.
Yeah.
We're not just going to find a new way to sell insurance. We're going to find a new way to underwrite insurance.
Sure.
And I think the thing that a lot of people have been grappling with is that there is so much data out there right now. Everything's collecting data. And the way that you make your risk pricing more accurate is putting more data into it, faster, more accurate data. But a lot of the problems that the big insurers have is that whilst they would love to do this kind of thing, their systems just can't handle it. So if we talk a lot at 11FS about bank core infrastructure, insurance infrastructure is even scarier. It's even older. So their ability to to do that step where they know that they need to use this data.
Sure.
And as you say, by using that data, they can give you policies that actually work for you. It's Jason's policy. It's not, this person in this age bracket who lives in this area with a house this size. Yes. It's actually for your particular property.
Yeah, because it breaks that underlying model. I mean, we see it in banking a lot, that actually if you can go digital, you can create products that are, and services. You go from that commodity product to service that's better for the end customer, and it's cheaper to run. And that with that cheapness to run, you can offer a better financial deal. So you end up at this weird space where it used to be, if you want super bespoke insurance or banking, it's super expensive. And if you want the bog standard stuff, that's it's cheaper at the bottom. And now I can get this, but over here, you actually are at the cheap end. It just breaks that whole paradigm of, expense means my service gets better. Actually, not in the new world. And
I think the other interesting thing to point out about Lemonade as well is this kind of awareness of sort of the growing trend towards social and environmental sort of preferences amongst consumers. So I think one of the problems that I have found that insurers have is that because of the model we talked about earlier, where it's we didn't pay it back, but there's some extra money, so we're just going to keep it.
Yes.
Insurers have a really bad rep. People are either they're not going to pay out, or if they do pay out, it won't be the right amount of money, or they're not going to pay out at all and they're going to keep my money. So this idea of having a model where actually we're going to give something back. We're going to make a sustainable business, but at the same time we're going to allow you to contribute to a charity that's close to your heart.
Well, it's also that transparency, because actually from that, how much they're going to make in profit, percentage-wise. So there's transparency against that. And if if everyone puts their money in and no one has an accident and there's not a flood and there's not some big problems, then do we benefit from your cash, or does someone else benefit? So yeah, I find that interesting, because there's a whole thing of, do we buy products that do services for us, or do we buy products that represent us? For trainers or clothes and stuff, we're used to buying products that this says something about me and I feel it resonates with the person that I am. And I think the old traditional startup tech thing was, well, forget about branding, marketing. It's it doesn't matter. Actually, this is really about the service, the job to be done. If I make a better mousetrap, they'll all come running to my door. But there's something that's synergistic there. That actually, when you get people who are naively creating things from the ground up, and they want to do it in a way that has the values that are important to society and important to consumers now, and reacting against the financial crisis and all of that and the bad rep, and suddenly it's we're a transparent organisation, we do good things for charity, we protect people, we're building this from the ground up. It attracts talent, which we know is a core component of how these things are going to work, especially in a world where everything is going digital. The best coders, the best designers, the best people can work all over the place. So how do you bring them in? And it resonates to customers because it's no longer, while it can be a lipstick on a pig on the functionality wise, we've also had lipstick on a pig from employer branding, that actually, everyone looks at the ad campaigns and goes, oh wow, that bank looks amazing, and then you get in through the front door, and there's plenty of statistics that show the first 6 months after you join a large organization, your engagement with the brand drops because suddenly it's Wizard of Oz. You suddenly see what's behind the curtain and how the sausages are made, to mix lots of metaphors together. So there is something about it's about the pricing in the end. There's a functional thing, and actually being digital lets you really address that aggressively at scale. It's about those intelligent services and what are we doing and how are we thinking at it from the perspective. But it's also about that resonant branding. Monzo, Lemonade, there's plenty of examples where it's that heady mix of pricing, functionality and brand that kind of mixes together into something interesting.
Similar colours as well, actually. There's a lot of hot pink going on. The interesting thing for me about Lemonade as well is that if you think about the history of insurance was kind of a community safety net.
Yes.
It was very much everybody put something in to help. You never knew
back
when.
To is it Alpine farmers looking after their cows and things?
And if you look at, really interestingly, sort of one of my pet projects is Islamic finance. When you look at insurance in Islamic finance, nobody's allowed to make a profit. It's very much about the community. So everybody puts the money in, and it helps this person, this person, this person. If there's money left over, it either goes towards a community project or it's rolled around. So it kind of fits with what insurance should be.
Sure.
I guess to get back to the funding.
Although having said that, I am fascinated by this whole idea of people don't want what's insurance about? Is it really about me having an accident and needing money? Is it about guarding against volatility? Or is it about handling risk and reducing risk? Because in the end, if I'm healthier, health insurance companies do well. If I drive in safe parts of town, the car insurance is less likely to pay out. Because I know a few years ago we had a trend of suddenly we saw health insurance companies say, well, I'll give you an Apple Watch and I'll sign you up to a gym. And because actually if you do better, we pay out less. And that attracts me as well, because there's still this fundamental rub in traditional insurance of, if something bad happens to you, then we have to pay out. We don't want to pay, and we don't really want to pay out as an insurance company.
We don't want to give you the money really if we can.
Yeah.
I mean, I think we've seen a huge move towards that, partly as kind of insurers sort of cope with modern values and modern expectations, but also with this idea that insurers are to sort of preserve or sort of regenerate their reputations, moving towards prevention rather than cure.
Right.
So we'll help you prevent a fire in your house. So we'll give you a connected smoke alarm that triggers a call to the local fire station or whatever it is. And the same with kind of what you're talking about with Apple Watches, it's prevention rather than cure.
Yes.
So I think with Lemonade, they're not quite there yet, but what they are doing, in my mind, is providing a service to a huge group that are completely underserved, because people with not a lot of money don't tend to buy contents insurance, but then say their upstairs neighbour leaves a tap on and it comes through the ceiling and their whole flat is destroyed. It's nothing to do with the person who couldn't afford the insurance, but they have lost everything. And that's often the poorest section of society. So if Lemonade are providing a service that is affordable and at least gives them some coverage, yes, I know some people will say, oh, it's not a huge coverage, it's not whole coverage, it doesn't cover everything. But at least if it's something you can buy a new sofa, you can buy that, a new shirt to wear to work on Monday, then that's still worth looking at.
There's also an interesting dynamic around around the valuations of these companies, and there is a thing about being at this part of a business cycle, and suddenly people going out and doing big raises, but whether it's banking or insurance, we've had a lot of challenges recently that have gone by unicorn into multi-unicorn territory, which kind of says private equity, capital markets have some belief that the big players are not going to be able to mount an effective defense.
Yeah.
There's something that says when you've got that amount, there's at least some people in the world who think actually this is a viable bet. That they can take on the biggest insurance companies in the world, which is quite something. I mean, they've got all the capital, they've got all the customers, they've got all the brand, they've got all the bits and pieces, and yet there is this innovator's dilemma thing, which to my mind is about this discontinuity between digitizing what came before and the new players that are over that chasm.
I mean, like if you're looking at seed rounds, then people are hedging their bets, right? You're putting 1-2 million to something. You're hedging your bets. When you start looking at 300 million, 400 million, like that's not hedging your bets. And I know SoftBank has a war chest of $100 billion. I am aware of that. But SoftBank does have a history of picking the winners. It's also invested into Ping An in China, which is China's largest health insurance provider. It's given them $1 billion. So don't worry, Lemonade guys. There's more to come your way. But I think to your point, you can't ignore. You may question the valuation to a certain extent, but you can't ignore the amount of money they are being given to do something with, because. In my experience, investors don't just give you money to play with; they expect something back. Sure. And I know you've had experience of sort of working with this kind of.
No, I think it's bank insurance innovation teams are very hand wavy a lot of the time. The worst ones are very hand wavy, whereas and almost caricatures of startup culture. Yet the best startups are the hardest commercial organizations in the world. I've said it before. It's like. There's a certain runway in order to prove the next metric, and then people will decide whether you get to play on. So a lot of no one talks about which agile methodology you're using. It's like, make it work. If it's not working, change it. We've got a period of time, make it happen.
And if you don't do it, then there's no more money.
So, exactly. So the pitch deck that raises that kind of money is all up and to the right. Costs going down 99%. Next year it's going to be 80%. Reach is like this. New products like this. The product thing, we're cutting costs as well as driving customer revenue. Our brand is looking great, and suddenly you're like, okay, is this the start of a major hockey stick where they do become again a global dominant player? Because they are over that chasm. They're creating that new business operating model rather than saying, well, we've got a website, so we're digital.
Yeah, and I think it's that kind of like we talked about before, kind of like, is this a feature or is it a product? Like Lemonade is absolutely a business. And I think that means for me that and Insurtech funding is definitely not a bubble. Like I think, as you said, there are not. If you wanted to put together, all the companies that have raised this amount of money and all the unicorns in the world, despite the media attention it gets, there are not actually that many of them. And I think, if we're going to call Insurtech a bubble, then we have to call FinTech a bubble. Like we can't have one without the other. And I would just say that I think Insurtech is just getting started. So I really believe that the insurance industry is about probably 10 years behind the banking industry, in my experience. The worst of them, et cetera, you've kind of got bandwidth either side. So I actually think we're probably going to see more money coming to insurance.
Yeah, I mean, I did talk to the CIO of a big insurance company, a couple of months ago, and they were saying that that the board wasn't even getting into these kinds of conversations.
Yeah.
Which is an interesting thing because bank boards are all over it, are actually driving most of the change, and it's actually the middle layers of the organization where it's a problem. But the bank board, the CEO, non-executive directors are driving this. But for insurance companies still to be like, it's not that the question was difficult, it's like the question isn't even making it onto the agenda. Yeah. So that interests me because it really is this question of, is digitized, is it a bubble because we just don't think they're doing anything innovative? Or are people seeing the difference between digitizing and bringing together what's happened before versus something new from scratch? And I think that comes down to that is the key question. Because if it is all the same, then maybe it's a bubble and the big players can move along. Mm-hmm. But so many industries are suffering about the same thing. There was an article in the Financial Times today about index investing or something, but it was talking about if you're a big retailer, you're managing shops and staff and supply chain at the same time as trying to drive your online presence. Meanwhile, the new players are coming along and just doing digital sales.
Yeah.
And then, that's the same in a variety of industries and the same in banking. You're running branches and back office staffs and mainframes and massive infrastructure. Meanwhile, new players are coming along, just doing cloud-based from scratch. To your point around Lemonade, Tom Blomfield at Monzo has said, one customer service representative looks after 10,000 accounts, but the aim is 100,000 accounts. So how does that sort of custom-built workflow, compare against a big bank where you've got makers and checkers and multiple systems and everything else? It's like, it's fundamentally different below the waterline as well as that customer interface.
Yeah, I mean, you have to understand that this is a very classic metaphor, but turning the oil tanker as opposed to turning the oppie, But I think the thing with insurers, which is really interesting to me, if you look at the kind of the future of the insurance industry, is that traditionally you have very basic description of the insurance industry. We have brokers who sell the insurance, insurers who actually underwrite the insurers, and then reinsurers.
Sure.
And the reinsurers at the back are typically there because the one insurer can't hold that much risk, basically.
Sure.
Somebody once explained it to me like, so your insurer will underwrite a policy for if you're driving a car and you crash into a tree.
Sure.
And they'll pay out on that.
Sure.
But if you're driving a car and you crash into a train, which derails and sets fire to a power station, then your insurer can't cover that because that's a whole other load of risk.
Sure.
So then they are reinsured again. And what's really interesting is whilst the big insurers, as you say, are sitting on their hands or going, that's not a problem, it's just something silly over there. The reinsurers, and there are Munich Re, Swiss Re, they all have Re in their name. And I don't understand why. Can somebody please explain that to me at some point? But you can find them, Hanover Re, Munich Re, Swiss Re, are leapfrogging. So Munich Re is one of the backers of Lemonade. They're also backers of a huge number of other very successful insurtechs because they provide the reinsurance capacity at the back end.
Which I guess has like similarities with the whole like Goldman Sachs suddenly getting into retail finance. It's like investment banks or sovereign wealth or whatever. It's like the source of all the funds. Does it really want to put money in and pay for all of these these people to use its funds in different ways and make their cut as they go? Or given that actually the thing about digital is it changes distribution, so no longer is it about having branches or a website or it is about having a website. No longer is it about branches and thousands of brokers who come knocking on your door to sell you life insurance. It's about something that can suddenly reach a few billion people just by putting a website up. And that change in the power dynamic, it's no longer I own all the customers because I have 10,000 branches. Is like, well, you can go direct to the money, and here we go. Let's see it happen.
And the reinsurers as well. It's interesting. So they don't necessarily put their name on things. So there's two schools of thought. So some of the incumbent insurers are getting a bit better at running accelerators and incubators and whatever the latest word is for those things, where you get a load of startups in one place and watch them for 6 weeks and see which one you want to buy. Basically, as far as I understand it. But they're all getting slightly better at that, and they do have CVC. They do have CVCs. They have corporate venture capital. But what's interesting to me is that the two main sources of funds are either VC or private equity. Well, either VC or the reinsurers. Like they're the ones who really sort of nailed their colours to the mast in the insurance space. And so for me, that's kind of a double or triple, if you like, rethinking of the processes. So like the reinsurers are going, we don't have to just sit back here on our huge pots of money, like waiting for global catastrophe. We can actually get involved like further in, and then and of course they're thinking if we cut out the middle insurers, then of course there's more money for us. So I think that the insurance space is going to be definitely one to watch.
I've got loads of comments and loads of questions.
Are any of them nice?
So we've got,
Is Nigel there?
Dennis from Standard Chartered.
Oh, hey Dennis.
Mr. Bates rocks.
Dennis, you're my man.
David does a waving emoji and then a blowing your nose emoji.
Oh, David Breer, ill today. Get well soon, dude.
Dave Cunningham waves. Bob is waving.
I just feel like I should wave back at everybody. Hi, guys.
Nigel says different time zones were never an excuse.
They were never an excuse, and tell Mrs. Walsh that I'm very glad she let you watch.
we did have a question on Twitter though from Dexter Cousins.
Oh, a sensible question. Yes.
Is the play parametric insurance?
I love parametric insurance.
I have no idea what you're talking about, so this is going to be interesting.
So parametric insurance, I was actually just having a long conversation with producer Laura, who's our producer for Insurtech Insider, about parametric insurance. So parametric insurance, at its basic, is basically an if this, then that. So the two really obvious examples are, you've got insurance for a flight.
Okay.
Flight data is very widely, very publicly available. Your flight is cancelled, it triggers the insurance, and the money goes straight into your account. So you don't have to go through that kind of, that's a very, very basic idea of it. Another one for parametric insurance is they're starting to use it in crops and in agriculture. So a lot of people, if you're in the commodity space and you're a farmer and you have a field of wheat that you think you're going to sell at the end of 12 months, but you never actually know if there's going to be a hailstorm or whatever else, so you insure it. And again, weather data is very widely available. So say in the particular area you live in, there's a massive hailstorm and it flattens all the crops, instant payout.
So it's
I like it.
So there's obviously a need there for trusted data providers.
Yes, absolutely.
Because without turning the physical world into something that you're going to make a big financial decision over, then there are obviously weaknesses there.
Yeah.
And it must sort of threaten some of the business model assumptions because there's, I assume, like a breakage. There are people who suffer who don't who fail to make the right claim or don't make the claim in time, and actually everyone benefits from that because the price is lower because of that. Yeah. So there's some interesting stuff there.
I think for me that the exciting thing about it is the thinking about different ways you can use widely and publicly available data. So kind of like, did that plane take off on? Is this those are the easy sort of starting simple examples? I think as you get more complex, and forgive me, I don't understand the full complexity of it, but yes, those questions start to come into play. But
so I think you're saying yes, the future is parametric.
The future is not tomorrow though, maybe like 5 years or so.
Is it smart contract driven?
Well, yeah, there is a lot of smart contracted insurance as well because it links very well to parametric insurance, but I will leave that for Simon Taylor. That's much more his kettle of fish than mine. Pat, you were laughing at us. Did you have anything else constructive to add?
It was just Nigel saying, when do we get Jason to join Insurtech Insider?
Anytime you like, Jason.
When Jason learns something about insurance, maybe.
Have you learned something today, though?
I have learned something today. Maybe I could be like that naive person that just asks what does that mean?
That's usually me. Sorry, explain that again, please.
So Nigel, yes, I'm coming on Insurtech Insider so I can learn more about insurance.
We'll find you a slot.
Nice.
Any more, Pat?
No, not currently.
In which case, we will say thank you very much for tuning in. If you want more insight like this, but don't want to see my face, I don't know why you wouldn't. Did David write that? Thanks, Pat. Why not listen? I'm insulted now. Why not listen to our FinTech Insider or Insurtech Insider podcasts? They're all available on your favourite podcast providers. We started a question segment on the podcast. So if you have any questions for me, you can email me at sarah@11fs.com. If you have any questions for this particular, for the on-air show, the topic for which for next week will be announced early in the week, then please email podcasts@11fs.com. Last but not least, if you want a topic discussed on air, then hit us up on those emails or just tweet us at FinTech Insiders.
Goodbye.